Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Badger Meter.
If you find our talks useful, please consider subscribe, like, and comment underneath because today we are staring down a scenario that I think every investor either dreads or dreams about.
Yeah, depending entirely on your perspective, right?
Exactly. Yeah. I mean, we are talking about a company that has historically been this, absolute stalwart of municipal water infrastructure.
Which is usually a very slow, steady, predictable corner of the market.
Yeah.
You really don't expect fireworks there.
Right. No fireworks.
Yeah.
But recently they experienced this violent 17% plunge in their stock price right after an earnings report.
And honestly, calling it violent is kind of an understatement for this specific sector. I mean, the 17% drop for a utility infrastructure supplier, that is a classic capitulation event.
Yeah, it really is. And it immediately forces us to ask, a structural question. Are we looking at a business model that has fundamentally broken under new economic pressures? Or is this a textbook, almost generational opportunity to buy the dip on just a massive market overreaction?
Right, and that's the core mission for our analysis today. We really need to determine whether this massive repricing is just a panicked reaction to temporary delays or a red flashing warning sign of deeper decay.
Exactly. And by the end of this conversation, we'll arrive at a clear investment thesis for the next 6 to 9 months for you. So to really understand the anatomy of this drop, we have to look at the immediate trigger, right? The Q1 2026 earnings miss.
Yeah, the numbers were definitely jarring.
They were. I mean, sales fell to $202.28 million, which is down from $222.2 million in the prior year. And earnings per share dropped to 93 cents.
Right. And, when a company that is priced for steady growth posts a year-over-year contraction of that magnitude, the market's algorithmic response is just to shoot first and ask questions later.
Oh, absolutely. But what I found interesting was management's explanation. They came out and attributed this entire miss to what they called project timing.
Yeah, the old project timing defense.
Right. They are essentially asserting that the demand hasn't evaporated at all. It has merely been, pushed to the right on the calendar. They expect an improvement later in the year.
Which, is plausible in municipal spending, but...
But I am extremely skeptical of management teams hiding behind the phrase project timing. Let's use an analogy to break this down for you. I call this the traffic jam versus the broken bridge scenario.
Okay, I like that. How does that work?
Well, if I'm late to a meeting, I might tell you I'm stuck in traffic. That is a project timing delay. Eventually, the cars move, I get off the highway, and I arrive. But if the bridge ahead of me has actually collapsed, I am never getting to that meeting.
Right. The demand is just gone.
Exactly. So we have to figure out if management's excuse is just a temporary traffic jam of delayed municipal orders, or if their fundamental sales bridge has collapsed.
Well, the only way to really test the structural integrity of that bridge is to look at the foundation they built immediately preceding this drop.
Okay, so looking backwards a bit.
Yeah. Contrasting this recent quarter with their Q1 2025 performance reveals the actual, peak power of their business model.
And 2025 was a massive year for them.
Huge. Yeah. In that 2025 quarter, total sales surged 13% year over year. Operating earnings jumped 35% to $49.5 million.
Wow. 35%.
Yeah, and that performance was not an anomaly. It was driven by a demonstrable structural shift toward their digital and software-as-a-service solutions.
Yeah, the 2025 data was staggering. Utility water sales specifically showed a massive 16% year-over-year growth. So what you are suggesting is that the bridge isn't broken because we literally watched them drive a massive fleet of high-margin revenue over it just 12 months ago.
Exactly. Look at the underlying mechanics of municipal spending, right? A traffic jam in municipal procurement usually involves city councils debating budgets or waiting on federal infrastructure grant approvals.
Or delaying bond issuances due to volatile interest rates, right?
Yes, exactly. But the structural mix shift toward digital solutions proved itself emphatically in 2025. Municipalities are actively upgrading. So as those bureaucratic bottlenecks clear, the company's long-term high single-digit revenue growth outlook is still totally intact.
Okay, I hear the argument for a resilient business model, but if I'm looking at my portfolio right now, I have to ask a more fundamental question. Why do these municipalities keep coming back to Badger Meter in the first place?
That's the million-dollar question.
Right, because what stops a cash-strapped city from just sourcing cheaper analog meters from an overseas competitor to save a few $1 million on a city-wide rollout?
Well, the answer lies in their primary competitive moat. And that moat is constructed around incredibly high switching costs and regulatory lock-in.
Okay, break that down for us.
Sure. So their core technology no longer revolves around dumb metal pipes. It revolves around two integrated digital systems. You have the Beacon software as a service platform and the Orion cellular endpoints. These are advanced Internet of Things devices.
Wait, let's break down how those actually work mechanically. So the Orion endpoints, those are the physical hardware, right?
Yes, exactly. The hardware on the pipe.
Right, so instead of a guy walking yard to yard to read a spinning dial, this endpoint attaches directly to the pipe and transmits water usage data continuously via, like, 5G or LTE cellular networks.
Spot on. And then the Beacon software is the cloud dashboard. That's what the city council or utility manager uses to actually ingest all that data, automate the billing, and monitor the grid.
Okay, so you have this hardware and software locked together.
Right. And once a utility adopts that integrated hardware-software ecosystem, the operational disruption of replacing it becomes prohibitive. I mean, to switch providers, a city would have to rip out thousands, sometimes millions, of physical endpoints across countless neighborhoods.
Wow, yeah, that's a nightmare.
It is. And they would have to retrain their entire municipal workforce on a totally new software dashboard. Not to mention risking catastrophic billing errors during the transition period. The water meter is effectively the municipality's cash register.
Calling it a cash register clarifies everything. I mean, if your cash register goes offline, you literally cannot collect revenue. Reliability becomes the absolute paramount concern.
Precisely. A mayor is not going to risk the city's entire water revenue stream on a discount, unproven supplier just to save 10% on the initial hardware installation.
No way. That would be political suicide.
Exactly. And that specific dynamic grants them immense pricing power, effectively shielding them from those lower-cost competitors. The integrated ecosystem allows them to exercise value-based pricing.
Which is where the margins come from.
Yes, this is the exact engine that drove the company to achieve a record 42.9% gross margin back in Q1 2025.
Wait, nearly 43% gross margins in what appears to be an industrial hardware business? That is extraordinary.
It's basically unheard of. It is only mathematically possible because of that deep software integration.
It is the ultimate sticky business. I mean, once a city installs that network, the disruption of switching to a competitor is a zero-sum game. They simply won't do it.
Right, they're locked in.
But this leads to a critical pivot point for anyone evaluating the stock today. If the underlying business is so sticky and so historically profitable, what exactly is management doing with their capital while the stock price bleeds out on the public markets?
Well, management is actually deploying that capital aggressively, and they're doing it from a position of absolute financial strength. They possess what you'd call a fortress balance sheet.
How much cash are we talking about?
In early 2025, they were sitting on $131.4 million in cash and cash equivalents. And their free cash flow generation is phenomenal. I mean, even after finalizing a massive $184.9 million acquisition of a company called SmartCover.
Wait, they spent nearly $185 million.
Yeah, and even after that, their free cash flow surged nearly 60% to $30 million in a single quarter.
Okay, let me push back on that aggressive spending strategy for a second. Because they bought SmartCover for almost $185 million. And now they have just announced a definitive agreement to acquire UD Live for approximately $100 million in cash.
Right, back-to-back acquisitions.
Yeah. We are looking at nearly $300 million spent on acquisitions in a relatively short window. If I am analyzing a company that just plummeted 17% because they missed earnings due to project delays, I have to question whether management is getting distracted.
That's a fair concern. Are they empire building?
Exactly. Are they genuinely expanding their moat, or are they chasing shiny tech startups while ignoring the deteriorating fundamentals of their core operations?
Well, integration risk is always the hidden tax on aggressive M&A, right? Merging software engineers from a nimble tech startup with the corporate culture of a legacy water utility company is notoriously difficult.
Yeah, you have disparate sales teams, clashing code bases.
And overlapping administrative redundancies, all of it. However, looking at the mechanical function of these specific acquisitions kind of reframes the narrative. They are not pivoting to a new industry. They are augmenting their Blue Edge software ecosystem.
Okay, so it's complementary.
Very much so. And buying UD Leave entirely in cash, without issuing debt or jeopardizing their financial stability, signals profound confidence in their strategy.
Explain the actual mechanics of these acquisitions, though. What does SmartCover or UDLive physically do that makes them worth nearly $300 million to a water meter company?
Okay, so SmartCover utilizes highly sensitive remote sensors installed beneath manhole covers. These sensors use satellite communications to monitor wastewater levels in real time.
So they're looking at the sewers.
Exactly. If a sewer line begins to back up due to a blockage, the sensor alerts the city before the toxic sewage overflows into the streets or local rivers.
Oh, wow. Which saves the city from massive fines.
Exactly. And UD Live operates in a similar vein, providing advanced remote monitoring for environmental data. Basically, Badger Meter is acquiring the ability to monitor the entire municipal water cycle, not just the clean water going into a house, but the wastewater leaving it.
So they are effectively cornering the market on every drop of water in the city limits.
That's the goal, yeah.
Okay, but what about the bleeding stock price itself? I mean, while management is out shopping for software companies, are they taking any action to defend their own valuation?
Oh, definitely. And this is perhaps the most critical financial signal for anyone evaluating the downside risk here. In February 2026, the board expanded their share repurchase authorization by $75 million,
Bringing the total to what?
bringing the total approved amount to $150 million.
$150 million authorization right after a 17% drop is not a coincidence. That is a very deliberate signal.
Highly deliberate.
Management is essentially weaponizing their balance sheet, right? They're telling the market that they believe the stock is deeply undervalued and they are perfectly willing to buy the dip themselves.
Exactly. And the mechanics of a buyback of that size provide a massive buffer for investors. With the stock plummeting, management has a clear fiduciary mandate to execute those purchases aggressively.
Right, to buy low.
Yeah. Structurally, when a company is buying its own stock at that volume, it sets a hard floor of institutional demand. It physically limits how far the stock can fall because there is a guaranteed, deep-pocketed buyer waiting to absorb the sell-offs.
Okay, so let's summarize the setup here. We have a company with a sticky cash register product, bringing free cash flow, aggressively buying up environmental software assets in cash, and authorizing a massive $150 million stock buyback.
This is a pretty strong list of fundamentals.
It is, but the divergence between those fundamentals and the 17% drop is stark. So how is the broader market digesting all of this conflicting data? The technical repricing and the sentiment seem completely fractured.
They're totally fractured. You have to remember, prior to the earnings plunge, the stock had already been trading roughly 15% below its 52-week high of $237.67.
So it was already in a stealth correction, quietly losing ground.
Exactly. And then the earnings miss hits, and the floor just falls out completely. Short-term algorithmic trackers are heavily flagging it as a bearish, notable gap down.
And that technical trigger unleashes all the automated selling from momentum funds.
Right. But simultaneously, contrarian financial media is publishing theses declaring it a rare buying opportunity. They're literally saying, finally a buy.
That is quite the split in sentiment.
It really is. The market is violently trying to find equilibrium between short-term pain and long-term value. Momentum traders are fleeing the gap down because their models dictate strict stop losses.
But value investors are stepping in.
Yeah. Value investors are parsing the fundamental health of the business and seeing an entry point that rarely materializes. I mean, prior to this plunge, Barron's had named them to their 100 most sustainable companies list for 2025.
And high-quality, sustainable tech industrials rarely go on sale like this.
Exactly. Sharp, fundamental-driven downward gaps often create the exact long-term support levels where institutional value buyers aggressively accumulate shares.
Okay, but we cannot dissect market sentiment without addressing the speculative rumor mill, because there is a highly specific narrative floating around regarding the $100 million UD Live acquisition.
Yes, the AI rumors.
Right. Speculators are suggesting that UD Live might be integrating AI-driven predictive analytics for sewer and stormwater management. And I have to play the skeptic here. Is slapping the word AI onto city plumbing just a desperate buzzword play to attract retail tech investors? Or is there a legitimate mechanical use case for artificial intelligence in a sewer system?
It sounds like a buzzword, I know. But the use case is actually entirely legitimate and mechanically sound.
How so?
Well, think about traditional municipal water management. It is deeply reactive. A pipe bursts underground. A sewer overflows into a neighborhood. The city faces million-dollar EPA fines and lawsuits, and only then do they dispatch a crew to fix it.
Right, they fix it after the disaster happens.
Exactly. But predictive analytics changes that paradigm entirely. By utilizing machine learning algorithms to process continuous data from those smart cover and UD-Live sensors, analyzing pressure variations, acoustic anomalies, and historical weather patterns, the software can identify flow restrictions before a catastrophic failure occurs.
Wow. Okay, so it shifts the municipality from relying on expensive emergency disaster response to scheduled preventative maintenance.
Precisely.
And if a city can replace a stressed pipe on a Tuesday morning instead of dealing with a geyser flooding a downtown intersection on a Friday night, the cost savings are astronomical.
Huge savings. And that kind of software could easily command premium, subscription-based pricing. If they successfully bring that predictive AI capability into the Blue Edge ecosystem, they evolve from a hardware vendor selling meters to an indispensable municipal partner selling a citywide disaster prevention engine.
That is a massive narrative shift. Okay, so we have established the underlying mechanics of the moat, the strategic value of the M&A war chest, and the market sentiment. But if someone is evaluating this for their portfolio right now, they need a roadmap.
They need to know what to watch.
Exactly. We need to map out the specific timeline of recovery, what proves the traffic jam is actually clearing.
Okay, the first definitive proof will arrive with their Q2 2026 earnings, which are expected around July 2026. Because of the recent miss, consensus expectations will be reset much lower.
So the bar is low.
The bar is very low. But the single most important metric to isolate in that report is the book-to-bill ratio.
Okay, let me just intercept that term for clarity. The book-to-bill ratio is simply the ratio of orders received, the bookings to units shipped and billed, right?
Yep, that's it.
So if the ratio is above 1, it means more orders are coming in than are currently being fulfilled, which implies strong compounding future growth.
Exactly. Management stake their entire reputation on the project timing defense. If demand was merely delayed by bureaucracy and not destroyed by competition, we must see a strong improvement in those book-to-bill ratios in Q2.
Right. If the traffic jam clears, the orders should hit the books.
Yes. As delayed municipal projects finally receive budget approval, those orders should flood the books. An improving ratio will act as a massive positive catalyst, completely validating the turnaround thesis.
But those book-to-bill ratios only improve if cities can actually afford to spend the capital in the first place. Which brings us to the macroeconomic elephant in the room. Interest rates.
Ah, yes. The macro factor.
Cities do not fund massive infrastructure overhauls out of a petty cash drawer. They fund them by issuing municipal bonds.
And lower interest rates are the absolute lifeblood of municipal infrastructure spending. If the broader macroeconomic environment stabilizes, or if the Federal Reserve initiates rate cuts, the cost of issuing a 30-year municipal bond drops significantly,
And suddenly, those delayed modernization projects become financially viable again.
instantly unlocking the frozen demand.
Okay. And as that demand unlocks, we have to see if the $300 million spent on acquisitions actually translates to the bottom line. The official closing of the UD-Live deal is another critical marker, isn't it?
It is. Management needs to announce specific integration timelines and early cross-selling targets. They need to mechanically demonstrate how they are going to push UD-Live's predictive software through their existing municipal sales channels.
We must also ruthlessly evaluate the bear case here because the risks are substantial. The primary threat to this thesis has to be prolonged municipal budget tightening.
Without a doubt. If macroeconomic conditions deteriorate further or federal infrastructure grants become permanently bottlenecked, those Q1 project delays could easily bleed right into Q2 and Q3.
And that scenario would completely invalidate the timeline of our recovery model. Consider the reality of local politics, right? If a mayor is facing a severe budget shortfall in a recessionary environment, water meters seem like the absolute easiest line item to slash.
Oh, politically, it's the first thing to go.
Exactly. They're going to prioritize funding the police, the fire department, and the schools. They will simply tell the utility department to keep using the old analog meters for another 2 years.
I agree that assumes a logical political triage, but it ignores the mechanical reality of water infrastructure. Meter replacements are largely mandated and non-discretionary.
Non-discretionary, why?
Because water meters are physical mechanical devices. Their internal gears degrade over time due to sediment and usage. And as they degrade, they consistently underregister the volume of water flowing through them.
Ah, going back to our analogy, a degrading meter is a leaky cash register.
Exactly. The city might pump 100 gallons of treated water to a neighborhood, but the degraded meters only record and bill for 90 gallons.
Wow, that 10% loss of non-revenue water is financially catastrophic for a utility operating on thin margins.
It really is. The financial bleed makes replacement mathematically necessary. Furthermore, state and environmental regulations frequently mandate strict replacement cycles. A mayor literally cannot delay them indefinitely without violating state law or bankrupting the utility.
Okay, so this regulatory and mechanical reality provides a hard physical floor to how bad the demand destruction can actually get.
Exactly. It's a built-in safety net.
But we also have to account for the internal financial risks of integrating all this acquired technology. Rapidly swallowing Smart Cover and UD Live introduces severe integration friction.
It does. And management has already telegraphed this reality by reiterating conservative forward guidance, specifically targeting a 38 to 40% normalized gross margin.
Which is a pretty significant step down from the peak 42.9% margins we celebrated earlier.
It is. Management is recalibrating market expectations. They are signaling that the costs of integrating disparate software platforms and merging sales teams will create a short-term drag on profitability.
So the margins are likely currently peakier than the suppressed stock price implies.
Yeah, and settling back down to 38% is honestly just a necessary, healthy normalization for long-term growth.
Okay, so taking all of these variables into account, we have the broken bridge versus the traffic jam, the impenetrable cash register moat, the integration risks of a $300 million software pivot, and the $150 million buyback floor. What is the final verdict?
Well, synthesizing the structural advantages against the macroeconomic risks results in a 7 out of 10 bullish score.
That's 7 out of 10. Okay.
Yeah, the 17% post-earnings plunge exhibits all the hallmarks of a market overreaction to cyclical, temporary project delays.
Oh.
Wall Street's algorithmic panic has just temporarily obscured the company's successful structural shift toward high-margin digital water solutions.
So for the investor looking at this setup today, what is the actionable stance?
The official stance is a medium-term hold, strictly targeting a 6 to 9 month horizon.
Okay, a medium-term hold.
Right. The strategy is to play for the re-acceleration of those municipal project timings in late 2026. You monitor the Q2 book-to-bill ratios, you wait for the realization of the UD Live software synergies, and you rely on the $150 million share repurchase program to provide a protective floor against further downside volatility.
It really appears to be a rare entry point into a secular infrastructure winner that has just been temporarily beaten down to a washed-out valuation.
I completely agree.
Well, before we close, I want to leave you with a broader perspective to consider. We have spent this time analyzing budgets, integration friction, and earnings multiples. But consider the physical reality of the next decade.
It's changing fast.
It is. As extreme weather events escalate globally and municipal budgets get squeezed tighter by inflation, the digitization and predictive monitoring of our water supply is fundamentally changing. It is moving rapidly from a nice-to-have technological upgrade to an absolute survival necessity.
Oh, absolutely.
If a city cannot predict its infrastructure failures, it simply cannot financially survive the coming era of climate volatility. Something to really weigh as you evaluate the true long-term value of a company building the digital nervous system for our water grid.
Infrastructure is ultimately destiny.
Thank you for joining us for this analysis. Keep questioning, keep analyzing, and we'll see you next time.